Hi everyone, welcome back to Strategic Channel. My name is Larato, your host, your financial advisor and investment advisor. Today we're going to be talking about everything that has to do with a loan agreement. I know most of us are stuck when it comes to actually reading the terms and conditions of our loan agreements and making the right decisions for us. So if you are interested, please do stick around. Before we dive into things, thank you so much for the support. Thanks for liking and subscribing. And remember, we need to get those watch hours going, so please do watch till the end of the videos. And for our new viewers, welcome, a very warm welcome, and we hope that you will enjoy and you will stay here for the ride. So the first point that we'll be looking at is interest rate. So interest rate is simply what the lender gets to make from giving you this particular loan. So loan interests are actually quoted in per annum basis. Most times, you know that when you get a loan from a bank, you are actually told that you're going to get a certain rate. So this rate is actually prime linked, and this is actually controlled by the central bank. So that is what we are looking for. So when it goes to interest rates, people need to understand, one, what type of interest are you being charged? Are you being charged a floating rate? Floating rate, which simply means that the interest rate changes. Whenever there are changes in interest rates, you will see your loan payments or your loan installments are changing. And is it a fixed rate? A fixed rate, which means that it is a flat rate. Whether interest rates are going up or down, you will always be paying the same amount of interest on your loan. So it's very important to understand what these two different types of interest rates mean, because if it is fixed, it means whether interest rates are low, you will be charged a higher interest rate. So let us take for instance an example. Let us assume that the current interest rates, or our current prime as it stands, the central bank has kept it currently at 7.75%. So it means that if I'm paying a loan that is prime linked, it means that if I'm on prime plus 2, it means I would be charged a 7.75% plus 2. So the effective interest rate on my loan currently, if I'm using that floating rate, would be 9.75. Let's assume that interest rates go down by 0.75. That would mean then that my loan interest also goes down to 9%. So that's what we mean by a floating rate. Whenever there are changes in interest rates, the interest on my loan also changes. If, however, I am on a fixed interest loan, that means that, let's assume that for simplicity's sake, I'm on 10%. This means that even if the interest rates were to go down, I will forever be paying 10% on my loan. So it means that when interest rates are going down, I'll actually be paying higher, whereas if interest rates go higher than 10%, then that's when I'll actually be paying lower than the rest of the people who are paying the floating linked or the floating rate interest rates. So I think it's very important for us to know and to ask the question when we are with the people that are financing us, whether it be banks or micro lenders, to ask them what type of interest rate am I being charged and how much and how does it work. Because at the end of the day, we want to be shopping around for debt that is affordable and debt that we are able to pay off, and a debt that is actually not going to swallow us. So the second point that I wanted to discuss is the duration. So the duration of the loan is it's the term of the loan. How long am I actually going to be paying back? So in terms of duration, the longer the duration, the smaller your installments are going to be. But here's the catch. Because of the long term, or the longer you're paying, the longer period you're paying off this loan, it means that you're actually going to pay back more in terms of interest. So now, as much as paying it over a longer period means that it is affordable today, the question is, are you actually going to have the patience to pay interest over that longer period? Paying it off quicker might be expensive, or in terms of the installments that you're paying, but in the end you're going to pay less towards your interest. So overall you would have paid less towards the lender. So the third point that we'll be looking at is your monthly installment. So your monthly installment is made up of 3 parts. So the first part would be the amount that goes towards paying your interest. Then the second portion goes towards paying the principal. So the principal is the actual amount that you got approved for, which is your loan amount. And then the third one is composed of fees. So fees are things that include the initiation fee or your processing fee. So this is a once-off fee that you pay when you get the loan, and it's normally a once-off fee. There are administration fees that sometimes are being charged or levied every single month for processing the loan payments and everything else. There's also insurance fees that go into this as well. So there's quite a number of fees that go into your monthly installment. So it is very important, because this is where you as a consumer can start to negotiate and start to compare. So when we say go around shopping for debt, these are the questions that you want to ask. In terms of the processing fee, how much am I paying? Currently, you might be paying between 1% and it's actually a percentage-based fee. So you need to compare what this fee is, because the lower this fee, it means the lower you're going to pay in terms of the initiation or processing fee. The other thing that you can also look at is your insurance. How much insurance are you paying towards covering your debt if ever you were to default, in order for the lender to cover themselves for such a loss. So that as well you also have to consider, because different insurers actually offer different rates, and if you can ask the right question, you might find out that the bank that you are using probably has different insurers for different reasons. So start asking the right questions to make sure that the costs that go in towards your monthly installment are reduced as much as you can, to make sure that you can actually afford the loan payments. So the other issue that we are looking at is the issue of security. So most times when we are going to get a loan, you'll be asked questions like, do you have an asset? Your asset can be either a car or a land or a house. So the collateral comes in. Sometimes it's in the form of cash, which is a certain percentage that you put in a fixed deposit with the bank, so that if ever you default, then they can be able to access that money to go towards paying off the particular loan that you would have failed to pay back. When it comes to houses as well, in the same manner, collateral will work in the same way. The bank will end up selling the house in order to make up for the money that you actually owe them. So those are the kind of questions that you want to ask if there is collateral, because here is the catch. If ever I fail to pay this loan, my house will be repossessed and my children and family will be out of a roof over their head. So it's very important that when we are making these decisions, we know what we are putting at risk and what it means if ever things don't go the way that we want them to go. I think the pitfall that we normally see is that because we are so excited, I won't even say excited, because we are so desperate in order to get funds from these institutions that lend out money, we end up overlooking very important aspects that actually affect us in the long term. So these are such things that we need to look at. So the last point is our terms and conditions. Terms and conditions being the fine print. Did you read the fine print on your loan agreement? Most people I know don't. And the reason why we want people to be reading the terms and conditions of the loans is because, let's take for instance, you need to know what happens if I default. One, there are penalties that are actually associated with late payments when it comes to installments that are paid towards your loan. What happens in the case that I am retrenched? Do I get cover? How many months of my premiums will be actually covered by the insurance that I have been paying as part of my monthly installments to cover that period where I am out of a job? So these are important questions that we need to ask, because we don't know what is going to happen in the future, and life's misfortune always means that there can be things that will happen and things won't go the way that we planned. So what are the retrenchment benefits for the insurance that we're paying on a monthly basis? What happens if I miss a premium? What is the penalty? What does it mean next month? Are my installments going to be doubled? So those kind of things need to be asked, and we need to consider them. Is my credit score actually going to be affected? Because most times when you miss a certain number of premiums, the credit bureau starts flagging you, and then you actually appear on the blacklist as a person who can't actually pay off that debt. So it's very important for us to start thinking of these aspects and asking the right questions so that we know what we are getting into before we sign on that dotted line. Under the terms and conditions, you might also want to think of what we call early settlement. Early settlement, or you paying off the loan faster than what was stipulated in your loan agreement. Let's take, for instance, I found out that I have extra money on a monthly basis and I want to start paying extra towards the loan that I have. So we also need to ask these questions as to what the lender allows. Can I pay this back as a lump sum, or can I pay it back as an extra payment every single month as I'm paying off my monthly installments? And how does this affect the overall loan agreement? Because there are also penalties that are attached to you paying off the loan quicker than the bank or the other micro lender had anticipated. So it's very important for us to know what it means and what are the implications of paying off your loan much quicker. So one thing that you need to know is that as you are paying off your loan quicker, or you're making extra payments towards your loan, you need to actually ask them whether this is paying off the principal amount, because if I'm paying off the principal amounts, so it means my outstanding balance goes down much quicker. Or are you making advance payments on the installment, which means if I'm making advance installments, and let's say, take an example, let's assume that my monthly installment is 1,000 Rand, and then I decide to make another 1,000 Rand as an extra payment. Is that extra payment going to pay, if we're in April now, is it going to pay for April, May, which are those 2 months? Or am I actually taking that 1,000 to reduce my principal amount, which effectively changes my installment amount? So those are the kind of questions that you want to ask, so that then you know what it means when you're paying off this loan much quicker. So with that said, I know that was quite a mouthful, so I hope that we are learning and getting something out of this. So do remember to subscribe, to like, and to hit the notification button, so that whenever we post such exciting content, you'll be notified. Overall, after you ask all of these questions that we have just talked about, those that have to do with your interest rate, the duration of the loan, the installments, the fees that go towards these installments, and the terms and conditions of the loan in general, one thing that we also have to look at is your affordability, and we need to discuss what that affordability means. Affordability, simply means that are you able to make the monthly repayments towards your loan in the most relaxed manner and stress-free as you can. I think most of us, when it comes to loans, we normally go out looking for so much finance or so much of the loan that when a person says, will you be able to afford 3,000 over 3 months, we say over 3 years, we say yes. Only to find out that 6 months down the line that this installment is becoming too much for you to handle. And because it becomes too much for you to handle, you end up revolving or refinancing this loan, which also increases your term at the other end. So it ends up becoming a vicious cycle whereby we end up paying off our debt over 6 months, revolving and getting another loan. So we need to make sure that the loans that we get are for a specific purpose, and for that specific purpose only. Just because you got a call yesterday that said you can afford 150,000 loan does not necessarily mean you need to take that full amount. Make sure that you assess your needs correctly, and make sure the amount that you need, and check your monthly budget. Like we had said, you can click the link up here to access our 50-30-20 budget rule, so that you can see how you can start going on that budget route and see if you can actually afford this monthly repayment or installment. Because at the end of the day, we don't want you to be a dull person and you have your entire salary or entire income dedicated to just paying off your debt. So please do be aware of such things. So my final words, or the takeaway points that we can take from this video is: one, When it comes to you getting a loan, please do shop around. And some institutions do offer what we call a cooling off period. And during this period is where you get your loan agreement and you can look over it with a professional or a friend or family member who has a better understanding of such things, so that they can assist you with making the right decisions. This is also the time that you'd want to now go around and shop around and see if you can get better deals elsewhere. At the end of the day, competition is important, and it is important for one thing only: it makes the prices go down and it benefits us as consumers. And then the other thing is for you to take your time. Do not make hasty decisions that are actually going to affect you long term. And remember that you also need to consider your affordability, which we have said that it is you being able to afford your monthly installments without actually feeling strangled that now it's month end and you have to make your payments. Because what we call as soon as the income hits the bank, they go and withdraw the funds, and then when the loan installment is trying to go off the account, they actually find that there is insufficient funds to actually pay off the loans. So let us be a very responsible generation that makes sure that we make our payments on time, because at the end of the day, we still need the financial institutions and they need us as well. So we need to come to a relationship that is very well balanced, so that we get the most out of these financing institutions. So thank you for watching. I'll see you next time, and bye.